Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week, and we're going over Marvell Technologies, which is really Marvell Semiconductors, and it's up over 223% year to date, and most of that has taken place in the past couple of weeks. And folks, remember, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Well, let's look at this company. And Marvell Technology, through its main subsidiary Marvell Semiconductor Inc., is a fabless designer of semiconductors used for data storage, transmission, and management in the PC business, infrastructure, and consumer electronics markets. But that's not what's moving the stock right now. And let's look at some other news. Now, number one, it recorded quarterly results driven by AI infrastructure. Revenue up 28% year over year, and the highest quarterly revenue in the company's history. And management also guided for strong growth as AI-related demand expands. And number two, the stock surged after high-profile Nvidia endorsement by Jensen Huang, CEO of Nvidia, was quoted as saying Marvell will be the first trillion-dollar company. Whoa, and that's when the company moved. And the company's shares jumped more than 30% in early June, well, just the other day, after those comments. And Huang highlighted Marvell's importance in AI infrastructure. Now, new AI networking product launch of its Telelinks T100, described as the industry's first 102.4 Tbps, whatever that means, Ethernet switch designed for AI and cloud data centers. And the product is aimed at the rapidly growing market for large AI clusters and high-speed interconnects. So we keep looking at stocks, or keep hearing about stocks that connect these semiconductors together using low energy, low heat, and quickness. In other words, it's got to be fast. And so, folks, these are the kind of companies that we don't hear about until all of a sudden out comes news, like from Nvidia's CEO, that says, hey, this is an important company. And let us look at some numbers here. And I know there's a lot of numbers, but let's look at owner's equity. This is how much the owners who own stock in the company actually own after expenses and operating costs, etc., etc. So we could see that this owner's equity, which is totally different than the owner's equity you see on the balance sheet, because it's configured in the clean surplus methodology. But what we see here is a nice steady increase and just taking off for 2026 this year and 2027 next year. That brings the clean surplus return on equity, which again is totally different than the traditional accounting return on equity. And we can see that it was an okay company, doing pretty good in certain years, and it just hung in there, and then all of a sudden it came out with its connector that's wanted by the AI infrastructure folks, and all of a sudden this clean surplus return on equity went up, and now it's above our threshold of 20% for a growth portfolio. So now we have to consider Marvell as one of the stocks that is definitely a candidate for our growth portfolio. But you're going to see why we didn't jump in just yet. And when we look at the 3-year, the 5-year, the 10-year average ROE, what the market looks at is that this is going up. Just like the clean surplus ROE going up, that's what the market looks at. That means that this company is making earnings at an increasing rate. Now, there are companies out there that we all know of and we've heard of all our lives that keep growing their earnings, but they grow their earnings at a steady rate, and that's what we look for. But then we have companies like this that are growing their earnings at an increasing rate. In other words, accelerating their earnings. And this company is one of those companies. Retention rate in the 90s. That means it's putting almost everything that it makes back into the company in order to grow. Net income growth for the average stock is about 13%. This stock is growing at double the average large cap rate. And the revenue growth at 22% is 3 times the 7.1% of the average stock out there. So the revenue growth is growing very, very nicely. You can see in these years in here how well it's growing and continues to grow, bringing that average up, and that translates into a net income growth. So let's see what is done in 1 year. Well, black line down here is the S&P 500, and you can see this company was doing pretty well, beating the average stock out there because the market knew that it was a pretty good stock. And then all of a sudden, in the past 3 months or so, this stock just took off like a rocket. And why are we not in it right now is because, boy, we would like to see it take a rest in here and fall back a little bit and regain its composure and make sure all the numbers are correct. And then we will probably start nibbling on this stock. But right now, it's still shooting right up to the sky. Everybody wants to get in this stock. But let's see a little market correction, or what a little market correction will do, and let's see if this stock can just settle down to where we can look at it and make sure that those earnings projections are coming to fruition. And then over the past 5 years, yep, you could see that it's been a better than average stock for the most part. And boy, when the market starts to go up, this stock really shoots. The market comes down, it comes down with it. Then all of a sudden the market just gets on a trend going up and this stock really shoots up, comes back down again. And this time it has really gone up. So over the past 5 years with the market up, and that's the black line here, up 80%. This stock is up 564%. Folks, that's phenomenal. But we have to be careful in here because everybody's chasing this stock right now. Let it wear off a little bit, and then we'll see if we're going to get into it for our 2027 portfolio. So, folks, what is our goal in building portfolios? Well, we want to build our wealth faster and safer with better than average stocks. And why do we want better than average stocks? Because there's a difference between volatility and risk. Volatility represents the ups and downs of the market and the ups and downs of certain segments of the market, and risk is losing your money. So that's why we want to build wealth faster and safer, there's that word in there, than the average stocks. So folks, we've had a wild week again this week, and if you want to get on the sailboat and sail around into that sunrise, or in this case into the sunset like Jimmy Buffett used to do, then you've got to learn how to invest even better than Warren Buffett does now. So folks, go out, forget about the market for the weekend, be with your loved ones. Most of all, stay healthy, stay safe. We'll see you back here in a couple of days.